Dear subscribers, we are excited to have you as part of a monthly newsletter group. Through these letters, we cover topics that are at the top of the mind of many investors. We try to make our content more engaging for our subscribers. Hence, this month, we are providing the content in a video format as well. Through your feedback, do let us know how you find this new format. Today, we are covering the state of the Indian equity market. Since its high in September 2024, Indian equity markets have fallen significantly. Nifty small cap index is now in bear market territory, being down 22% from its highs. Similarly, Nifty Mid Cap 100 index is down 18% from its highs and approaching the bear market territory. Nifty 50 index is also down 14% and clearly is in correction. What we don't understand or don't realize from these broad market corrections is the full extent of losses in individual stocks. To give you some stats, around 100 stocks have corrected more than 50%. Around 600 stocks, in fact, have corrected more than 30%. So if you have holding in any of these stocks, you are really hurting badly. This damage have left many of the individual investors shell-shocked. In our last newsletter, we talked about how correction in the stock market provides a very good opportunity to a long-term investor. In this newsletter, we are answering some of the questions that investors are thinking about.
What has caused the correction in the Indian equity markets?
Now, there are no one single answer here, so I will give you a few pointers which have caused the correction in the Indian equity markets. And the key one clearly is the selling by foreign institutional investors. So foreign institutional investors have been selling not just in 2025, they have been selling consistently in the year 2024, 2023, 2022, and 2021, as the table on the screen shows. It was only in 2020 that was the only year in this decade where FIIs were actually net buyers in the secondary market. So we have to realize that FIIs are pulling money out, and there is a reason. And the reason is that FIIs are finding other markets much more compelling than Indian markets. So we think that this sort of selling will at some point have to abate because FIIs have sold a lot and they are significantly underrepresented in the broader world indices where India is also represented, like the emerging markets. So that's one reason. The second reason has been the weak earnings in Indian corporates or weak earnings of Indian corporates. If you look at the chart or the table that we are showing, and this table is from MK, what you will notice is that in Q1, Q2, actually the earnings were negative in terms of the growth rate. Not the earnings were not negative, but the growth rate was negative, as in the earnings fell in Q1 versus Q1 of last year. Similarly, in Q2, the earnings fell again from Q2 of last year. It is only in Q3 that we have started seeing some growth. And that growth, as you can see, is around 4.6% for BSE 500 and around 3.1% for Nifty 50. Very weak growth by Indian standards, and that is one of the drivers which is causing the valuations to look high and for people to be less excited about the Indian equity markets. The third reason is the valuations that I was referring to earlier. While weak earnings are definitely part of the reason, the other part is that because there were so many participants last year in the Indian equity markets, the valuations ran much more higher. As you will see on the chart, Nifty 1 year forward price to earnings has now fallen to around the average, which is around, let's call it around 20. And so now when you look at Nifty 1 year forward price to earnings, it is below that average. And so the valuations have become more reasonable. If on the other hand, you look in 2024, it had gone way above average, even going beyond the one standard deviation above the average. If you then look at the Nifty mid cap index, you will once again notice that the mid cap index rose a lot as reflected by the valuations in terms of the trailing 12-month price to earnings ratio. And now it is coming closer to its average. By the way, the average here is around 35 times. So in absolute terms, it is still quite expensive. Lastly, coming to Nifty small cap 250 trailing 12 months price to earnings, you can again see that it has come below average, and that average is still 30 times. So you can see that Nifty 50 is among the cheapest among the three types of indices that we have talked about. So apart from these three factors that we talked about, there are many additional factors that are causing this correction, including higher US Treasury yields, dollar strength. As we have seen, the dollar has risen a lot, and similarly, rupee has depreciated quite a bit. In addition, I talked about how the foreign institutional money is rotating from Indian equity market to the Chinese market, and also the US economic policy that we know will have impact not only on India but many other parts of the world through the tariffs. So all these are driving what is happening in the Indian equity market.
How long will this correction last?
Now, this is a question on everybody's mind, and the frank answer is we don't know. However, what I think we can provide are a few pointers that our readers and our viewers can monitor to understand the turning point. So the first turning point would be if earnings rebound. In our previous question, we mentioned that earnings were quite weak in financial year 2025. Combine those low earnings with high prices, and Indian equities looked a lot more expensive as compared to other opportunities for the FIIs. We think as the earnings start coming back strongly in financial year 2026, as you see on the chart, some of the headwinds around the earnings growth will vanish, and that will allow the equity markets to start performing well. MK is talking about having earnings which will grow in double digits in financial year 2026. The second factor we think which will help the markets recover is the government policies, both economic policies and monetary policies. Now, when we look at what happened in financial year 2025, they were impacted because there was the central government election, which prevented the government from having its normal capital expenditure, and many projects got slowed down. We also had a relatively higher interest rates which were prevailing in India, which made many projects unviable or not as lucrative. And then also last year in 2024, financial year 25, there were situations around high heat and flood waves which also impacted the productivity of the populace. Now, as we go into financial year 2026, many of these factors will reverse. Why? Because as the new central government elections are over and we have a stable government, we expect the government is going to be growth oriented, and they will continue to come up with new projects which will allow the growth of the Indian economy to once again flourish. We know recently RBI reduced the repo rate for the first time after 5 years. And so that means that RBI is also once again starting to focus on growth oriented policies. We think that as the real interest rate in the economy comes down, more projects will become viable, and we will see many more projects start. The third pointer here is a lower personal tax rate. The budget announced that the tax rates across all slabs have moved lower, or the slabs have moved higher, effectively reducing the tax outgo for most individuals. And this will provide more money in the hands of the consumer, which should provide a demand push, allowing the economy to once again pick up. These are two things. And then the third thing which we will talk about is the base effect. When we were looking at financial year 25, we were looking at how the companies have grown in financial year 24, and therefore what is expected in financial year 25. Now, as we saw earlier, financial year 25 economic performance has been weak, both for the economy but also for the companies. As we go into financial year 26, we will expect that earnings will grow faster from a lower base. Why is that? Because every country has a certain earnings growth potential. India, we think, is somewhere between 6 to 8% real growth rate, and we add 2 to 4% inflation, let's call it 4% inflation, then in nominal terms, we are expected to grow between 10 to 12%. So if last year the growth rate was 5%, we think that the earnings growth in financial year 26 can be much better. That will be another driver for Indian economy as well as Indian equities to start doing well in financial year 26.
What sectors have not been affected by the correction in Indian equity markets?
While it is helpful to know what has worked well, it is not necessary that those same sectors will continue to perform in the future years. Hence, we will encourage our readers and our viewers to not put undue importance on this next chart that we will show you. Why? Because mean reversion is a very important force and most businesses go through that cyclical pattern. So now let's come to the sectors. You will see that the electronic manufacturing providers have done very well last year. They grew at 71% in terms of the earnings growth. On the other hand, telecom had losses because of some of the providers having losses, but some other companies have done well. Cement was really struggled. On the other hand, real estate from our earnings growth was very strong in financial year 25 so far. NBFCs have done well, insurance have done well. Now, so all this gives you a flavor of which sectors have done well. It doesn't tell you which stocks have done well because this is more looking at the earnings growth of that particular sector. And so what is important is to always keep in mind what is the valuation for that particular sector. So earnings growth is maybe already accounted for in the stock price, and hence what is a good business may not be a good stock. And therefore one always have to consider the valuations of the companies before investing.
What are some of compelling sectors that one can invest in?
Now, let me elaborate a little bit of what we think we need to have in an investment to be successful. Some of the attributes includes it is a business that one understands. Second, it should be a business which is run by a good management. And lastly, it should be a business that is available at a good valuation. So even if first and second are good, it is a good business with a good management, I don't think it is necessarily a good stock because it is already priced for the good business and good management. So valuation becomes very critical. Now, if we look then at what are the sectors that some of the brokerages are suggesting will do well in financial year 2026, we show a chart here and you can see that communication services, consumer discretionary, consumer staples are sectors that are expected to grow well. What are some of the sectors that may not do as well? Energy is one sector, healthcare is another sector. And so one has to take this with a pinch of salt because it tells you what sectors will do well, but it doesn't tell you what companies will do well. And it is important to remember that when you're investing in a company by company and not into a particular sector. So this can be a good starting point for you to know where to look and then look at what companies are available at a compelling enough valuation that you can take advantage of the current prices. Now, when we look at ourselves, some of the sectors that we like are lending businesses, which is covered under financials, real estate, which is not at all in the Nifty that we showed you, and lastly, capital markets. We think capital markets has a very long runway as India becomes much more financially savvy and they take advantage of the opportunities that the Indian equity provides.
I am currently having significant losses. What should I do?
Now, portfolio gains or losses at a particular time should not influence an investor's behavior. An investor should buy a stock because it is available at a good discount to what the investor thinks its value is. And as the value becomes less and less, it becomes less compelling, and therefore the investor should be open to selling it and looking at something else. So most of the time, there has to be a big enough gap for one to buy, and then the gap has to be quite narrow, possibly even less than narrow for you to sell, because you have to look at what are the alternatives. Now, what does happen, and we have noticed it many times when we talk to our investors, is that bear markets, like what we are going through now, or sharp drawdowns, bring out the worst in an investor. Even for an investor who thinks they're long-term with multiple year of horizon, they start looking at the stock portfolio not only on a quarter basis, but on a daily and a hourly basis. Now, why are they doing that? They're doing that because they're afraid that markets will keep hammering their stock down and they want to get out of their stocks before these stocks go down to zero. The reality is different. The reality is that stock will reverse once the earnings come and the businesses perform. So it is important to relax and realize that markets will go through cycles, and so will your portfolio. Just because your portfolio has gone down is not a good reason for you to obsess over it. However, it is a very good time to understand what you own and why you own it. This is where understanding the 3 criteria that we talked about in the previous question, which is good management, good business, good price, and then buying and holding a stock which you like, is very important. If you do that and the stock that you own goes further down, guess what? It may be an opportunity for you to buy more. So in our mind, drawdowns may very well provide a very good opportunity for an investor to take advantage of a sale that is going on in the stock market. Remember, when you like something, it is on sale, you buy a lot. It's the same thing what you should do in the stock market for any stocks that you like. This is your opportunity. Go and grab it. The one caveat to the above answer that I just gave you is that if one wants to harvest the capital losses to offset the capital gains, then that's a different thing. But this should be done with extreme caution, because many times selling a position to harvest losses causes one to get out of a good position which is having a compelling valuation. I personally did it with a MAT 7 stock in my portfolio in 2022, and I am unfortunately much worse off for it. Thank you. Do let us know your feedback and what we can do to make our content more engaging, what we should do to present things in a manner that will resonate more with you. Thank you.